However, there are some important details to cover here related to investment taxation. First of all, you are only taxed when you sell or once a gain or loss is realized. This is a major misconception out there. People think that just because they bought a stock and the stock went up, that they automatically have to pay taxes. But what you have there is something called an unrealized capital gain, and you have to realize that gain by actually selling some or all of those shares, and your profit, or the difference between what you bought for and what you sold for, is the amount that you pay taxes on. Depending on how long you held that, it's either going to be short-term, maximum tax rate, or long-term capital gains. So it's very important to keep track of how long you have held onto an investment and consider the tax advantage of going long, especially if you're somebody who's in the upper tax brackets. Also, capital gains from a short sale are always taxed as ordinary income, regardless of the duration. So just to give you guys an example here of how this could save you money, let's say your income is taxed at 35%, and your short-term capital gains tax rate is the same at 35%. However, your long-term capital gains tax rate is just 15%. So let's say, for example, you sold the stock on day 365, which means you did not hold it for longer than 1 year, and you recognized a capital gain of $10,000, you're going to pay 35% tax on that, or $3,500. But let's say instead you waited just one more day and sold on day 366. You had the same capital gain of $10,000, but you only paid 15% because that is now a long-term capital gain. You just went from paying $3,500 in taxes to $1,500. In this bracket, the tax advantage would be 20%. This is based on a couple of years ago. I'm not sure if these brackets have changed, but this was a real example from when I did this here. So I recommend looking at the tax bracket yourself and comparing your short-term versus long-term capital gains rate, and the difference between the two is the amount that you save by going long. And then there's another fun category called the capital loss. If you lose money on an investment and you recognize a loss by selling, this is considered to be a capital loss. And a capital loss is typically deductible. And it can be used to offset other income from a capital gain. There are limitations to what you can deduct from your taxes. So again, talk to your tax advisor.